In the 13th and 14th centuries, European commerce exploded. Merchants suddenly needed massive liquid capital to fund ambitious overseas voyages. But there was a massive theological roadblock. The Catholic Church strictly prohibited usury, the practice of charging any interest on a loan. If you lent money and demanded a guaranteed profit back, you were committing a mortal sin. This created a severe crisis in wealthy Italian city-states. Deeply religious merchants sitting on gold had to choose between financing the booming economy or facing excommunication and social ruin. This is a table tracking the maximum interest rates charged by licensed pawnshops across medieval Europe. Local secular authorities tried to regulate public moneylenders by setting these hard limits. In England and Bruges, the rate hit 43.33%. Borrowing money openly was incredibly costly and still carried the risk of spiritual condemnation. Europe had the capital, and merchants desperately needed it to grow their operations. But unless they could find a way to secretly compensate lenders for taking on risk without triggering the church's wrath, the commercial economy would suffocate. Bankers solved this with the bill of exchange. Moving heavy chests of gold across Europe was dangerous, making traveling merchants prime targets for highway bandits. So a merchant deposited local currency with a banker in one city, receiving a piece of paper to withdraw funds elsewhere in a different currency. Because traveling long distances took time, bankers baked a hidden interest rate into the future exchange rate. The church approved. Since the final payout depended on unpredictable foreign exchange markets, theologians considered this a risky exchange, not a usurious loan. The physical danger of medieval travel and the volatility of foreign currency markets provided the perfect theological camouflage to charge for the time value of money. Foreign trade was covered, but local business funding required a different approach. The only church-approved way to invest locally was the societas, or partnership, where you shared in both the business profits and the potential losses. Passive investors, however, wanted a guaranteed return on their capital without taking on business risk. But drafting a contract with a guaranteed payout was exactly what the church defined as a prohibited loan. So merchants devised the triple contract. They started with a profit-sharing partnership, then added an insurance contract guaranteeing the original capital. Finally, a third contract traded massive future profits for a low, fixed percentage return. Each individual contract was entirely legal under canon law. By stacking them together, clever merchants mathematically engineered the equivalent of a modern, fixed-rate corporate bond without ever officially calling it a loan. City-states like Venice and Florence fought constant, expensive wars. They required massive amounts of capital to keep their armies equipped and in the field. To raise funds, governments forced their wealthiest citizens to surrender chunks of private assets, pooling the money into massive consolidated public funds known as prestiti. Because returning the principal was often impossible, the state structured the payout differently. Instead of repaying the initial lump sum, the government promised citizens a continuous annual stream of income. The church opted to look the other way. Since citizens were forced to hand over their money, the payout was legally classified as purchasing a future income stream. Because it wasn't officially a loan, it escaped the usury label. The state's desperate need to keep soldiers armed and fed legitimized these fixed income securities. Under the politically acceptable guise of civic duty, the foundation for modern sovereign debt was laid. Over time, these intricate workarounds, the bills of exchange and the state debt certificates, evolved into incredibly valuable paper assets in their own right. Merchants realized they didn't have to wait months or years for these contracts to mature. If they needed cash immediately, they could sell the paper to third parties in secondary markets at a discount. This explosive trading forced a legal evolution known as negotiability. Secular law merchant courts in commercial hubs like London and Antwerp started recognizing the rights of these third-party paper holders. For the first time, a debt obligation could circulate freely, functioning almost exactly like modern currency. This specific legal evolution didn't happen everywhere. In the Islamic world, religious and secular laws were unified, meaning merchants there didn't face the unique legal friction required to force the creation of impersonal, tradable corporate debt. The strict moral constraints of the medieval Catholic Church didn't stop finance. Instead, The intense pressure to exploit these loopholes accidentally forged the complex, highly structured global financial system we rely on today.